Hey everyone, it's Evan here from The Trade Risk on Friday, February 16th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So we saw a huge recovery in stocks this week. We basically recovered all of last week's damage. We saw the VIX close back below 20, really coming back down into a more normal sort of range, still much higher than we saw and experienced throughout 2017, but much better than a 30-40 VIX handle that we saw over the past 5 or 10 trading days. And we also have markets closed on Monday. So we have a long weekend. We get a little extra time to get away from the charts and strategize a bit. And in this video, I want to talk about this rally that we've seen so far. It looks and smells like a V-shaped rally that gets us back to those highs. So I want to talk about some of the things I'm looking at, if this is going to become a V-shape, retest back of those prior all-time highs, or if we're going to fall short and sort of roll over some of the indicators and levels I'm paying attention to. So stick around. All right, let's jump in here with the S&P 500, the SPY ETF. We're looking at a weekly chart here, and you can see on this weekly time frame this strong bounce that we talked about at the opening of the video, 4.44% rally here in the SPY. That's good for 11.5 points off of or retracing the damage from last week. And when we look at this weekly chart now, we are back above a rising 8 and 20 period EMA here on the weekly time frame. We've seen a nice bounce off of this trend line, which extends all the way back to January of 2016. This also coincided right at these lows here with the 200 period SMA, a widely watched simple moving average, and we can see that strong reaction off after such a sharp decline and reaction lower. We are back to last week's highs. In fact, if we go to all of the major averages, you can see we basically got right up to last week's highs and found a little bit of a pause there, basically in the Qs closing right underneath last week's highs. And if we look at the Russell 2000, you can see we also closed just under last week's highs as well. So that was pretty much the mark here for the bulls getting a good reclaim, a good bounce. Volume was light, kind of as you might expect, a little under half of the shares traded compared to last week. So maybe a little bit lighter than we would have preferred, but nonetheless, from a price action perspective here, very healthy. The longer term trend, longer term structure of this market is very much intact here after a very sort of questionable 2 weeks. So when we look at the daily chart, things aren't as rosy, as clean. There's still some uncertainty here, and I think we can try and break that down in the next few minutes here. So basically, when we recap today's or this week's action, what we saw was this was Monday's candle here. So we started off with a gap higher to start the week, to start the temperament of this trading week, and that was following Friday's very large range reversal. So this is the big wick that we saw down here to tag that 200 SMA. We closed back above these recent lows here, above the trend line, and we saw that nice reversal. We got follow through right away on Monday. Tuesday was basically the slowest sort of digestion day here. Didn't do a whole lot, basically held our ground, and then we continued higher, over 1% on Wednesday, over 1% on Thursday. We almost had an over 1% here again on Friday, but we did get this late day or midday reversal in the markets, pulling us off of this north of 275 print all the way back down to about flat here in the S&P 500. So when I look at this market here on a daily chart, you know, coming into this week, I never thought we would be up 4.5% or almost 5% here. That was certainly exceeded even my most bullish scenario. But when I look at this structure here, last Wednesday, this 272 level, I'm still paying attention to this level. I think it is pretty important here. You can see we closed above it, but right in that general area. And you know, my philosophy is I don't care about being exact. I don't have trend lines to the penny or to even to the nickel or the dime. I'm really looking at the general area on how markets react in certain places. And for me, this is still right right around, we definitely overshot it throughout intraday, but we ultimately closed right here, right near this Wednesday's high back on the 7th. And I think this is going to be an interesting area at play. And I think for me, when I start to think about the action next week, the longer that we can hold above this 272 area, this 272, 272.50, this general kind of 50 cent to $1 area, the more we can hold above there, the more constructive, the more sort of bullish I would give the bulls credit for a potential continued move higher. Now, it's not just this level I'm looking at, it's also where the 20 period and some of these fast moving averages kind of lie as well. Now, notice we are above both the 20 period EMA and the 8 period EMA, the yellow and blue lines on my chart, but they aren't in a what I would consider a bullish formation. Traditionally, the most bullish charts are when you have price above a rising, in my case, 8 period, which is the blue line, moving average, which is above a rising 20 period. So you have this nice stack of price, fast moving average, and then the slower one below it, and you have everything kind of sloped up, moving in the right direction. In this case, we have a sharp bounce back, a sharp retracement into declining or bearishly aligned moving averages. That to me is always a retracement. It's always a point at which I'm actually I'm more looking at a market to potentially roll over at that point, not to necessarily remount it and then pick up the, kind of pick it up and continue to a second higher move. So for me, when I look at the S&P 500 here and I look at this recent action, I still view this move here as the impulse leg, the emotional kind of move down in the market. And on the daily chart, on this very kind of shorter, looking back about a month or so, I would consider us in this reaction, this retracement in the context of this bear leg down. So essentially what I'm interested in and what I'm paying attention to next week to see is if this turns into a lower high here, which ultimately, we fall back and we put in a lower high and we start heading back down towards these lows or inside of this range, or do we in fact find ourselves in another situation where we get a full V-shaped rally that is a complete washout here in 7 days, and then in near equally as fast of a fashion, we are back to testing and retesting or making all-time highs. Those are the two sort of scenarios that I'm running through in my head, and I don't think you have to have extremes in either way. I think a sideways range-bound market is possible here as well, and in fact, I think it is the most likely scenario that a range develops, and whether it's between 285 and down to 255 with a very wide 30-point range, or if the range develops more right between, say, 275 here, the highs from Friday, and the lows down here, or even like this, some chop in here would be a interesting or even likely scenario, I would say, as well. So looking at next week's action, I'm very interested in two spots. One, basically this 272 level, which would be the highs from Wednesday, so call it 272. If we see follow through back below here, that would at least give me some structural signs that we kind of failed here to hold above this 20 period EMA for more than just this single day, like we did close above it here on Friday. But if we were to fall quickly next week and we fell back below this 20 period, back below these declining moving averages, which are bearishly aligned, and this pivot from Wednesday, that would give me some sort of either comfort or acknowledgement that the bears, the sellers, still have kind of a hold on this market, that we're not just quite ready to rip back up to new highs. On the other hand, if we do see stabilization here, if we can pop up, if we manage to open the market green on Tuesday and we hold into green territory, we stay above 272, then that, to me, the longer we can do that, the more sort of constructive, or the more credit I would give the bulls at this point to potentially continue higher and maybe, in fact, get back to these prior highs. I think the highs here for all of the major indices are going to be important from Friday. I think this reversal, this reaction here from 275, we're up 6 days in a row. Markets had the strong recovery bounce higher into or exceeding some past resistance. I think this here, these highs from the intraday session are going to be important. If we start to close above them, then I would immediately start to think about moving back towards 285 as a potential retest of the prior highs here. So I think this is going to be an important area. We're closing right at it, and I think the action early next week should be fairly telling. If you're into fibs, you can draw the fib here from the highs back to the washout sort of lows here, and you can see intraday we did pop above that 61.8% retracement. We did manage to close below it, so we are in that kind of that sweet spot of that last line of the line in the sand area of that 50% to 61.8% retracement. So far, I'd say if that holds and we start to see a rollover here, we do need to respect the fact that sellers could be back in control of this market, or at least whip us around in a potential sort of sideways range here for the foreseeable future. Another thing I'm looking at is market internals, and I posted this chart on my Twitter feed last night, and this is from yesterday's this is yesterday's action, so this only has Thursday's close on it, doesn't have today's action. But when we look here at this chart, what I have on the lower end of this chart below price is I have the net number of NYSE new 52-week highs minus 52-week lows, and then in this lower pane I have the McClellan oscillator, which is looking at basically momentum of the advanced decline line. I consider, basically the 52-week high list, high minus low list, is more of a longer term sort of barometer of market health. I say the NYMO here is a little bit shorter term, so it's a little more noisy and tends to oscillate a little bit quicker. But for both of these indicators, notice here we've spent this full rally basically in red territory. We were very oversold in kind of both of them. Although I don't, in the NYMO we were very oversold. I wouldn't necessarily say that in the number of 52-week highs and lows. But we did see basically throughout this recovery in price, we saw a normalization back to the zero line. And I'd say going forward, looking ahead now, if this is going to continue to be a nice, strong, clean, uptrending bull market, I want to start to see expansion in breadth to the upside. I want to start getting back to like we saw in November and December here. I want to start seeing the number of 52-week highs back up above 100, 200, 300. I'd like to see those types of readings to give me the kind of utmost confidence that this market is back on track, behaving exactly like it was last year. And every retracement or every dip or bounce has to start somewhere. So I don't want to get too negative here in saying that this is extremely bearish, because we have to start somewhere. But this is sort of what I'm looking for, is stabilization next week in terms of price action, and also start to see stabilization and improvement and expansion in market internals to the upside above the zero line in some of these indicators. There are others to look at, and there's lots of different ways to interpret them, but these are sort of my two favorite. I know the NYMO on Friday did gain more ground to the upside. Again, I do consider that more of a shorter term. I think it's the 52-week lows and highs list is something I'm much more interested in going into the future. And another comment I'll make about these two, or using this type of analysis here with market internals, is we could very well continue this rally higher and retest these prior highs here and get back up to this 285 level. But if we do it on weaker internals, or we basically don't budge much from the zero line on some of those charts, that would set up an interesting sort of retest of highs with a slight divergence in market internals, which might set you up for, you know, a sell signal maybe later in March or second week of March or something to that effect. So that would be the longer term view if we do continue to actually V-shape higher here, stabilize and continue higher. Those are certain things I'd be looking at as well. So in the short term, you know, in the short term, I'm paying attention very closely to essentially this 2 or so point range. You know, this 272 back up to these highs here at 275 for that immediate sort of direction. But right now, I would still not say we're out of the woods yet. Looking at this daily chart, just given the fact that we've only retraced still 50 to 60%, this impulse leg to the downside still in control. I still think you want to manage risk and stay, you know, aware that risk can happen. In fact, if we do decide to roll over here with about a 50 to 60% retracement. So that is how I'm looking at the S&P 500. When I look at the IWM, I think I made a comment last week saying, you know, the IWM is really just not that interesting until we can start to clear back above this 150 to 151 zone. And here we are. We're above it already. So it is interesting that we are above it. We have cleared back above some of this prior supply, a lot of supply in that 150, 151 level. The weekly chart, we're above the 20 period. So when we look here in the shorter term, the daily chart, again, we're not out of the woods, but I do like the fact that we're above this general area here. And the same concept applies, is I'd like to see us just hold up here, let these moving averages kind of catch their breath, turn back around, get into bullish alignment, let us know that the selling pressure is you know, more confidently over, and then that the buyers can take us for potentially another leg higher here. Great start, good bounce, but I don't think we're out of the woods here for the Qs. I mean, I'm sorry, for the IWM. And when we look at the Qs here, certainly making the most progress. You almost actually got a crossover of some of these fast moving averages here this week. On Friday, we did see kind of the biggest reversal occur here in the Qs, down 0.5% after being up, you know, almost 1% earlier in the day, around 160, almost 167 or so. But same kind of comment applies. This time we are above Wednesday's pivot high here more definitively, and like unlike the SPY, which is kind of still trading right at it. But same comments here. I'd like to see us stabilized, hold above some of these fast moving averages, turn them around, base out a little bit, and then potentially get ready for either a leg back higher or a rollover back into this old range. So that's what I'm looking at there for the major markets. And I should state that I do have a short position on now in the S&P 500 here. So I do have a short position on, still have long exposure on, but I definitely still have that tactical short, a little bit of an aggressive entry here, but we're going to see if this can potentially roll back over. If it starts to take out these highs up here, you know, the stop is somewhere situated up closer to 280 or so. But like I say, if we start to take out these highs around 275, Friday's highs, probably be out of that trade. And that is what I would consider a tactical trade. So it's something that I will be much quicker to manage. So by the time I do this next update, I might be out of that position. Maybe I'll still have it on, but you know, it's definitely something that's going to be a nimble sort of trade management style on that position. So let's move into some other markets here. We'll go to TLT next. TLT, you can see on the weekly chart, did manage to hold positive here. If we look here back to the daily chart, you can see it basically spent most of its time just chopping around, and then the progress it made Friday here to the upside is what the net sort of result was on the week. You can see still very firmly bearishly aligned moving averages coming down, kind of hammering above price. So structurally, this thing is in a very difficult spot here on a short to intermediate term basis. I do think, you know, a bounce can happen. It is oversold, right? There is always the possibility of a 1 to 2 to 3% bounce here in some of these names. 3% would probably be pretty big here for TLT. Nonetheless, I still think we could get a reaction back up to 121 or so, but I don't necessarily, you know, at this point, I don't see enough evidence that you'd want to be buying that. It'd probably be an interesting sell opportunity if we got a rally back into some of this prior supply and longer term or that 20 period moving average. So sellers in control there. If we go to oil next, you can see Oil had a constructive week, up 4.5%. You can see holding around that 20-period EMA here on the weekly chart. When we zoom in here, you can see it's rallying back up to some of the fast-moving averages there. We talked about this in last week's video. If you're interested in buying the dip in oil or looking for that retracement, this was the biggest retracement we've seen, and these levels would start to get kind of interesting down here. So we did get that bounce. Still yet to be seen whether or not the lows or this is a definitive sort of higher low here, but buyers are trying to support this and push us higher. Natural gas, not so much. This thing just pretty much flatlined down here at these lows. Reluctant to bounce, hasn't quite got back to the December lows, so it's kind of just sitting here in kind of no man's land. I'd expect, given the fact we've had basically 3 inside sessions here, well, I guess 2 back-to-back inside days, that this is setting up for a fast move early next week. So I think when this resumes trading, you're going to have a pretty good momentum opportunity either to the downside or back to the upside. So take a look at that coiling action for you very short-term nimble traders. Intermediate term swing position, I don't see much here that looks attractive right now. So I think the sellers still have the benefit of the doubt for natural gas. When we go to metals next, we got GLD, which had a nice week here, 2.5% to the upside, getting back to these prior highs. Stumbled a bit here into the end of the week, but basically it's made some nice progress. Essentially, it found support right in here around 124.50 or so at this little January shelf of support, and we are back to the upper end of this range here. We still haven't quite broken out from the 2018 highs here, right around 129 or so. Maybe that happens next week. I'm still paying attention to gold. I still like the formation. Still not involved in it, but something I am paying attention to. Maybe a clear through 129 would be the case, or unless something sets back up within this range to jump on board of. But I like GLD, pay attention to 129 on the upside. And then finally silver, you can see getting back up to this prior range here where we gave a good amount of trading in between the first 4 weeks of January, late November and December, and a little bit of October, around the 16 to about 1630 level. So there's a good amount of price memory in here. We're trying to bump our way back into it. I think that'd be a good first line or first good sort of accomplishment there by the bulls if we can get back above $16, and then you're going to be paying attention to about 1630 or so to the upside, but looks like it's trying to firm up here. Pay attention to that $16 level, maybe get you back up into that range. So those are the major markets there. Let's take a look at some of the other some of the sectors now that are holding up best in class here. So we had semiconductors up 5%. This is one of my favorite kind of coming into this week. This was a position that we had on from last Friday where we got in here, not playing it via SMH, but playing it via SOXL, the 3X levered ETF on the semiconductors, looking at the SOXX as its underlying ETF. But regardless, if you're looking at SOX or SMH, it had this nice move off of these lows, basically right where the December lows were, back into the midpoint of this range, back up to where there's some prior supply in here right around November or so. We no longer have this position on. We sold the rest of it yesterday on Thursday. So we don't have this position on anymore, but it did get a nice rally. It is very much in a kind of clear, identifiable sideways range here. And the resolve of this, I think, especially for the market as a whole, is going to have some pretty big implications on whether or not we roll over and break down from 165, or if this turns into a big continuation pattern. Don't suspect we're going to see that resolve over the next week or so. It's probably going to take a little bit longer, but something to pay attention to. Semiconductors had a nice week. Let's see again if these moving averages can firm themselves up. Maybe we get back to these prior highs here. I think they're going to, they're going to help kind of dictate what the major market does as well. Biotech also pretty good, best in class this week, 6.5%, particularly looking at the XBI here, which is the equal weighted, more of a smaller cap weighted ETF for biotech stocks, but you can see this had an impressive rally off of the reversal from last week, 6% to the upside. The fast moving averages here, 8 and 20, already bullishly aligned. So you can see if you're looking at sectors, biotech really got it done this week. Saw a nice move back up here. I like it, something I'm paying attention to. Over my watch list of stocks that I was paying attention to this week, lots of names in this space were really the ones setting up. So biotech was a good winner for us this week. XLI kind of, you know, on a intermediate term, or kind of in the middle of the pack here, the industrials saw a nice recovery this week. Let's see what the percentage was. So about 4.7%. So fairly in line with the S&P 500. You can see it looks very similar to the S&P 500, frankly, but it is trying to stabilize here. Nice recovery. It's trying to hold above that Wednesday pivot. Kind of middle of the road there. I think that's going to pretty much move along with the market as a whole. And financials kind of in this middle of the road bucket as well. Wasn't quite a top performer, but still got a nice bounce off of those lows. So very much like XLI there, XLF would be in that camp. On the downside, what's not moving so quickly off of the lows, first is energy. Energy here is just really kind of stuck in neutral, hasn't really found a bounce. It got hammered over basically the last 2 or so weeks here, and it's just been kind of stuck at these lows. It hasn't broken down any further. It did manage to close positive on the week, but still structurally, this thing is very quickly back into sort of the penalty box here. Maybe you know, a reaction higher or some type of rebound reversion is in the cards here, but until it gets back above $70, I mean, structurally, this thing looks pretty difficult there. XLV, so healthcare more broadly here, you can see just on the relative basis, look how far off the highs this is. This really got kind of clobbered here over the past 2 weeks or so, and it did get a reasonable bounce higher this week, but still on a relative basis, you could argue that this acceleration here into the end of January was even more extreme in healthcare. So that could very well be the case, but on a relative basis, still very much off of those highs. So something to be a little bit cautious there. In healthcare, staples, from a structural standpoint, this is a weekly chart. Looks quite a bit different than some of these other sector ETFs that we're looking at here. You can see lots of supply back in here from around $56 or so, going back multiple years even. So this XLP staples are in a pretty tough spot. IYT I would also put down here, hasn't quite made a strong recovery back. When we look here on a relative basis, we're still quite far off of these highs. We're kind of still hanging out right at this prior supply here from December. The weekly chart, we just barely, you know, kind of recovered that 20 period, but still below the 8 period EMA. So a little bit sluggish here in this kind of bottom half of the sector ETFs, and you could throw real estate in here as well. Not much of a recovery or move off of these lows from a relative basis, very far off of the highs here, but this is one of the earlier ones to start breaking down. So some things to think about there for your sectors heading into next week. So I think that's everything I have. Hopefully you guys had a nice week trading. Thanks so much, as always, for watching the video. If you do like it, do subscribe to our YouTube channel, and enjoy the extra day off. I will talk to you on Tuesday.